Yeah, here we go. So ideally, traditionally, when we're thinking about investments, these are the traditional options that you've always known, or rather we've always had. So if someone, even while we were in school, in college, wherever, in high school, wherever you started hearing about investments, these are the options that you always had people talk about. And one of them is stocks or equities or shares. This is the most common form of investment that people know about, and that's why we have so many people who have invested in dormant stocks that have been losing value, or rather have not been gaining anything for decades. So among within stocks, there are other classes, what you call exchange traded funds and index funds. Those also are cumulative assets, or rather cumulative indexes that are composed of different assets to form a single fund that you can invest in. That's to mean that it's like 20 stocks, or rather 20 shares, or rather 20 listed companies being brought together and compiled into a single fund or index fund that you can invest in, so that the performance of your investment doesn't depend on a single stock, but it depends on the cumulative bunch of stocks that have been placed in a particular fund. So that's part of what we've known traditionally as the available investments options. And the other one has been government securities, the treasury bills and the T-bonds. These ones are very common. And they're among I would consider them the safest investments that you can make, because this is money you are lending to the government. So the government will have to pay you at some point. The government will rarely fail to pay, or rather fail to honor on its debt. So this is lending money to the government in exchange of a certain return that is paid. Maybe it's paid semi-annually, or maybe at the end of the duration for which you've invested. So government securities are very common investments options. And then the other one is money market instruments or unit trust funds. These ones are like they're like mutual funds which pool funds from different investors, and then use that pool of funds to invest in different asset classes. So there are a couple of options within the money market instruments that you can choose based on your preferences. Maybe you would choose to invest maybe in equity funds, or maybe a balanced fund. So these are the details that we'll continue covering as we progress through the session as part of the traditional assets that we have, because we believe it's good for you to have the foundational knowledge about the available options that are there and how you can invest in them before we even go into the advanced or maybe the unconventional asset classes are there. And the other one, of course, is real estate or small businesses, or maybe operating small businesses, or maybe operating in REITs, or rather what we call real estate investment trusts. These are part of investments that allow people to invest in the real estate directly or indirectly, because you understand real estate is a high cap investment option, which means you require a lot of resources for you to invest in real estate. So what some of these options provide, like the REITs, is that they give you an option to invest in real estate, not as a single individual, but as a bunch of people. So you invest in a fund manager that invests in real estate, so that you are an indirect owner of the real estate that these people have invested in. So these are the part of the traditional asset classes that we've been used to, and people have invested in these things, and probably we have knowledge of how to go about it. Some don't. And in an honest evaluation among all these asset classes, you would realize that in the last financial year, the government securities were the highest performing, with a return of 13.4%, which is a good return. It's a very good return, because it means if you invest like $1 million, you'll make 134,000 at the end of the year. So basically, it's a good return. But now, for a small investor, like what you usually call wakulima wadogo, the return is not as appealing, because what happens is, with this kind of returns, they favor those people who we call the high net worth individuals, like someone who can afford 100 million and then they invest in a bond that yields with a yield of 13.4%, that person will make 13 million in return. So, and then you can break that down into monthly. So that's like you're making 1.3 at the end of every month. So which is not bad for a large investor. Now, for a small investor, this doesn't make so much change in your life, or rather it's not as appealing or inspiring. And that's why we need now to come back and evaluate the options that we have and think about this small investor with the small amounts of money at their disposal, or that disposable income that they can invest. So what is there for those people? Does it mean that, given that the traditional assets that are there, does it mean that these people then cannot create wealth? Because most of the young people, that the stage we are in, we are what we call wealth creators. We want to create wealth for ourselves and for our generations. So unlike the people I call the baby boomers, those who are born in those who are maybe above the age of youths, not the adults, but those who are a little bit elderly, maybe into their 50s, late 40s, or even 60s. These are probably people who have who are at a stage where they need to preserve their wealth. So the kind of risks these people can take is different from what a 20-year-old would take.